Governor Dr. Wayne Robinson and Deputy Governors Natalie Haynes, Karen Chinky-Aiken, and Robert Stennett. The format of the press conference is fairly straightforward. Governor Byles will make his address regarding yesterday's monetary policy decision, followed by the question and answer segment. I ask for this segment that you use the chat feature. Governor Byles, over to you.
Thank you, Melanie. Good morning, ladies and gentlemen, and welcome to this special press conference. As you are no doubt aware, the Monetary Policy Committee on Tuesday and Wednesday of this week decided by unanimous vote to increase the policy interest rate by 100 basis points to 1.5% per annum. The committee also signaled its intention to continue to reduce the level of monetary accommodation, or more simply put, continue increasing the policy rate at subsequent policy meetings, subject to inflation and other macroeconomic data evolving as projected. Accompanying this policy rate increase, the committee decided to maintain other measures aimed at moderating inflation expectations, including the containment of Jamaican dollar liquidity. Finally, the MPC reiterated that while the bank does not target any specific level of foreign exchange, Bank of Jamaica will continue to ensure that movements in the exchange rate do not threaten the inflation target of 4% to 6%. Our aim here today is to outline and explain the factors which led to the decisions taken by the MPC and the expected impact of these decisions. It is important to remind everyone that the Bank of Jamaica has had an accommodative monetary policy posture for a number of years, progressively cutting interest rates to a low of 0.5% in August 2019. In support of economic growth and in the context where inflation generally remained within the bank's target range, we have kept the policy rate at that historic low level since then. In addition, at the onset of the COVID-19 pandemic, the bank injected significant liquidity into the system, both Jamaican and US dollars, amounting to approximately 313 billion, or 16% of GDP. We have consistently said in our communications that we will maintain this accommodative policy so long as there is no threat to inflation. At yesterday's meeting, the MPC noted that inflation for August of this year had breached the upper limit of the bank's target range and that the risk of inflation continuing that trend over the next 2 years had intensified. The recent significant increases in international commodity prices and shipping costs have had a higher than expected pass-through to local prices and have contributed to further increases in inflation expectations. In addition, consumers are being faced with higher agricultural prices as a result of the passage of tropical storms Grace and Ida in August of this year. And that has also contributed to a worsening in inflation expectations. Importantly, even when we exclude the effects of volatile prices such as agriculture and energy, underlying or core inflation has been rising and is above the bank's target. The MPC is of the view that if it does not take action in order to limit the second round effects of these increases in prices, then inflation expectations will rise further and will lead to even higher price adjustments, causing inflation to remain above the bank's target range for a protracted period, lasted a year or even more. With this background, let me now speak in further detail to the latest inflation outturn, as well as the bank's latest monetary policy decisions. The upside risks to the inflation forecast over the next 2 years have intensified. The inflation rate for the 12 months leading up to August 2021, as released by Statin, was 6.1%. This is above the July outturn of 5.3% and above the upper limit of the bank's target rate. The acceleration in inflation is primarily reflected, I beg your pardon, the acceleration in inflation primarily reflected the effects of higher pricing for both processed and agricultural food, meals consumed away from home, and transport services, which are all related to the weather and to the increases in international commodity prices. There were also higher prices for selected services, such as education. In the latest survey of inflation expectations, businesses, I repeat, businesses indicated that their outlook, that is looking forward for inflation over the next 12 months to July of next year, had increased to 7.4% relative to the 7% in the previous survey. There has been an upward trend in inflation expectations over the past 2 years, and these expectations have been elevated, especially since the onset of COVID-19, placing them outside of the upper limit of the bank's target range. Without action, expectations are likely to become unanchored and will more seriously affect price setting decisions in the goods and labor market. Finally, the recent passage of tropical storms Grace and Ida affected the island just last month, I beg your pardon, August of this year, and had a negative impact on agricultural prices, agricultural supplies, particularly vegetables. This shock to agricultural supplies has already started to affect prices and adds an additional 1 percentage point to the inflation forecast relative to what we had outlined in August of this year. In the context of this updated assessment and what it implies for inflation expectations, the MPC's decisions are designed to ensure that inflation will gradually fall back within the bank's inflation target of 4% to 6% in the shortest possible time. Let me spend a minute in discussing how our policy actions affect the economy. As I indicated earlier, BOJ's suite of policy actions to reduce monetary accommodation include the moderate 1% increase in the policy rate. Secondly, an intensified focus on ensuring that movements in the exchange rate do not threaten inflation. And thirdly, a more active management of Jamaican dollar liquidity. BOJ, of course, also reserves a right to increase the policy rate further. As we reduce the level of monetary accommodation in the system, market-based interest rates will rise. This rise makes the return on Jamaican dollar assets more attractive relative to foreign currency assets. It will make savings in Jamaican dollars more attractive and borrowing in Jamaican dollars more expensive. In so doing, interest rate increases will temper the demand for foreign currency and hence moderate the pace of depreciation in the exchange rate. And it will reduce demand in the economy generally, and with it, the ability of businesses to pass on price increases to consumers. We are aware that there are concerns about the impact of this policy decision on growth in the economy. The suite of policy actions, beginning with a modest increase in the policy rate, has been calibrated to minimize the adverse impact on growth. Bank of Jamaica's assessment, therefore, is that even with these actions and potential future actions, GDP growth will still fall within the range of 7 to 10% for financial year 21-22. Indeed, just yesterday, the latest statin GDP figures indicate that the June quarter grew by 14.2%, significantly more than was expected. While the decision to increase the policy rate may affect growth in the short run, the bank and the MPC are concerned that if we do nothing now and high inflation becomes entrenched, growth over the longer term will be adversely affected. Low, stable, and predictable inflation is considered more important and more conducive to long-run sustainable GDP growth, wealth creation, and the amelioration of poverty than an environment of persistent high inflation. Ladies and gentlemen, let me conclude. The Bank of Jamaica is committed to fulfilling its mandate by ensuring that a growth-enabling macroeconomic environment is in place, characterized by inflation returning and remaining within our inflation target range of 4 to 6%. The outlook for inflation over the next 2 years, whilst being initially affected by shocks, is also at risk from much higher inflation expectations and is underscored by the rise in core inflation. Bank of Jamaica's action yesterday to reduce monetary accommodation is aimed at addressing this issue and influencing a return of inflation to our target in the shortest possible time. We will continue to closely monitor the economic environment and are prepared to take further actions at the next MPC decision meeting in November this year in order to achieve our inflation objective. Thank you. I will now take questions.
Thank you, Governor Biles. Ladies and gentlemen, I remind you to please use the chat feature to type your questions and send them in.
I see Al has his hand up.
Right. I see a question from Siobhan Campbell. Concerns have been raised that this policy rate decision will push up borrowing rates and affect those businesses that rely on imported raw materials for their goods. What is your response to that, Governor?
Well, as I indicated, it will have more than one effect. It will make savings in Jamaican dollars a little bit more attractive, which means the availability for lending is a little bit reduced, makes lending a little bit more expensive too. But what it does is dampen generally demand in the economy, and it will make the exchange rate a little less pressed to depreciate. And all of that has the effect of holding down inflation. So it's more than just increasing the cost to businesses. That will happen. But most importantly, what will happen also is a reduction in demand and easing of the pressure of the foreign exchange market.
Thank you, Governor.
Maybe I can ask Senior Deputy Governor Wayne to also express our view on that.
Yes, you've hit the nail on the head, Governor. Yes, we do recognize that interest rates will rise generally in the economy, both borrowing and saving rates. It boils down at the end of the day to the magnitude of the increase. And as the governor indicated in his statement, we have tried to calibrate the adjustments so as to minimize any adverse impact. But there is going to be some impact. The second channel that the governor mentioned is also important, and that's the exchange rate channel. Because whilst yes, borrowing cost is going to go up, we're trying to dampen the cost of imported goods by our approach in terms of one, how the interest rate will affect exchange rate, and as the governor indicated, we will be taking a very close and proactive approach in trying to avoid or minimize any unnecessary and erratic movements in the exchange rate.
Thank you, Dr. Robinson. I'm going to go to Al's question. Good morning, Governor. With the world economy getting back on track, oil prices are on the rise. It's already at $880 a barrel. Will this not lead to a prolonged inflationary impact?
Yes, I don't know if it's 80, but it's in the 70s. And it's a major concern, of course. What we have seen in the last couple of weeks is some moderation in some of the international commodity prices, whether it's wheat, corn, soya. Oil has been different. Oil has kind of stayed in the 70 range. It's concerning. But let me put it to you this way. If on top of the increase in the cost of oil and any other international commodity, we also have an exchange rate that is moving erratically, unnecessarily in a depreciating manner. What you have is a compounded inflationary effect. And so our intention is to try to make the foreign exchange market as rational as possible in how it prices foreign currency, as well as dampen the demand generally in the economy for goods, and reduce the ability of businesses, therefore, to pass on price increases. Everybody has to take a little bit of the bite off of the inflation momentum. If I could just say, one of the words that I kept repeating in the presentation, which perhaps needs a little discussion, is this word of inflation expectation. Expectation. So inflation that has occurred already from increased international commodity prices is a reality, and it has largely been passed into the economy, and we see it in the inflation rate. But it's a different thing to say that expectations, if that drives expectations to believe that there will be more increases, then, and if the exchange rate depreciates or people expect it to depreciate, then what that means is that we will make price adjustments, upward price adjustments, even without the cost increasing, because we expect them to increase. So we need to make a distinction between what has happened in price increases and what in our minds may happen and therefore impact prices. For example, apart from the foreign exchange, if in the labor market we expect that inflation will settle at 7-8%, then it means that in discussions, that is a kind of standard at which we will start the discussion, rather than if it is within the 4 to 6%. So expectations is really important. And that is one of the things that the bank is trying to put in its crosshairs and to fight against. People need to understand that we want inflation to be reduced, and we're doing everything to keep it down. So there's somebody leaning against inflation. It's not loose out there, and that will temper expectations about inflation. DG Robert Stennett, you have anything to add to that?
Yes, thank you, Governor. I just wanted to comment, just to amplify what you said about oil prices. Our forecast had anticipated that oil prices during the September quarter would have gone up a little higher, but our baseline forecast was and remain for oil prices to come back down. The noise that we saw in August and September, as you know, are related to the fact that hurricanes passed through the Gulf states and disrupted production. And you also saw, yes, correctly, the recovery in the economy, in particular the US, driving demand for oil prices. Going forward, however, we still maintain that supply is going to respond. I mean, there's an outside case where oil from the Middle East, particularly Iran, may eventually come back on the market. And generally, you will have supply responses from shale producers in the US and elsewhere, OPEC related, who will supplement the market. So while we are concerned that crude oil prices remain where they are, our baseline view is for them to come back off. And this is consistent across the board. Other forecasters also have that view. So yes, we recognize the implications of higher oil prices for inflation, but generally speaking, our view is that these prices will come off. Thank you.
If I could add, the Governor, there is a concern in the short term about LNG prices, as we have been seeing some upward pressure there. And we think the rise in LNG poses some upside risk to our inflation forecasts. Bearing in mind that LNG has become a significant part of our energy imports.
Thank you, gentlemen. We have 3 questions from Huntley Medley. What is the longer term outlook for interest rates? Where do you see the policy rate going over the next year? And wouldn't it be more helpful for decision makers to have a longer term signal?
Thank you, Huntley. We do have a model, economic model that we use. We build in increases in interest rates or reductions, whatever we contemplate, and we see what the model produces. So we in the Bank of Jamaica do have a pretty clear idea of the effect of various increases in interest rates. Not that we are in a position here today to tell you that, but what we will say is that we are going to be watching very closely what the reaction is to our actions today. And based on that, MPC will decide again whether it needs to make another rate increase. Let me say the 1% is really quite moderate. And I think people are saying, oh, interest rates have risen. Bank of Jamaica has increased the interest rate. Yes, we have, but the 1% is moderate and really is intended as a signal to people, decision makers in the business community, in the consuming community, that we are alert to the risk of inflation and we are prepared to take a stance. We don't think 1% is a massive increase that will fix everything. We hope to see a response from the economy that will guide us. Do we need to go further or can we leave it at that 1%?
Thank you, Governor. We have a further question from Huntley. The MPC has signaled changes to other monetary policy tools, for example, the exchange rate. What will the new stance mean for BOJ FX market interventions and rates on government paper?
Natalie, I wonder if I can ask you to address that. You look on this every day.
All right. Thanks again, Governor. Good morning, all. The exchange rate implications in terms of we said we would not allow the exchange rate to be disorderly, to disrupt our inflation targets. And that has not changed. That has always been the bank's stance. So that has not changed. Bank of Jamaica intervenes in the foreign exchange market whenever it assesses that there are demand supply imbalances that causes disorderly conditions in the market. So that has not changed. In terms of government paper, well, the signaling of an increase in interest rates and the actual increase in the policy rate will, of course, impact rates, yields on government paper. Recall the market is who determines the auction yields, and so we expect a slight increase in that, commensurate with the increase in the policy rate.
Thank you, DG Haynes. We have a question from Javon Keys. A wide spectrum of goods purchased locally are imported and priced in US dollars. How has the pass-through of the exchange rate impacted the inflation figures?
Wayne, you want to take that?
Yes, I'll start, Governor, and I think that Robert may probably have some more color to add. But first of all, I mean, the movements in the exchange rate, I mean, will impact domestic commodities because of the import content. What we have seen, though, over the years is that the magnitude of that impact, that is how quickly prices adjust to say a 1% movement in the exchange rate, that has fallen significantly. I mean, in the 1990s, early 2000s, a 1% movement in the exchange rate would see prices moving by the same amount within a year, a one-for-one movement. What we have seen certainly over the last 5, 6, 7 years, though, is that prices are moving by much less than that. Some anywhere between 40% to about 60%, Robert, or somewhere thereabout, within a year. Now, of course, a lot depends on the pace at which the exchange rate is moving. In an environment where the exchange rate is moving faster, I mean, yes, you'll have a faster pass-through. But the point is that the impact that we've seen is much lower than what we've seen historically.
Thank you, Dr. Robinson. A follow-up question. One financial analyst says that an increase of the policy rate may be an indication that the economy is shrinking. What is your reaction to that?
Not at all. And as I pointed out, just yesterday, Statin announced the GDP figures for the June quarter, and it showed a very robust growth of 14.2%, even beyond our expectations. So I don't think that the fact that we are increasing rates by 1% is going to damage that kind of robust recovery. So that's why I keep saying, to be saying, yes, BOJ has increased interest rates sounds like a catastrophe, but it's not. The 1% is not at all a very high increase. And I believe if people understand what we are trying to achieve, I'm hoping we don't have to adjust those rates too much more in the near future.
Thank you, Governor. We have another question from Huntley Medley. Given that rates have not been increased since about December 2008, the rate increase is being taken as a major reversal in not just the BOJ stance, but also government policy. Has the BOJ taken this into consideration?
Yes, well, rates in 2008, Robert, you probably remember better than I, they were in the teens almost. Robert, why you don't address that? Your gray hair qualifies you to address it.
Thank you, Governor. Yes, I would say that over the past decade or so, interest rates have been coming down. I wouldn't want to characterize the trend in interest rate over that period as a government policy. The declines that we saw in interest rates were more the outcome of the government taking steps to correct its indebtedness by adjusting the fiscal balance. And in so doing, it allowed interest rates to go down because the extent of demand that the government typically exerted was reduced. And it therefore gave Bank of Jamaica the appropriate space, given that inflation was well contained, to guide interest rates downwards. But we wouldn't want to characterize the path for interest rate as a government policy. More importantly, given that the Bank of Jamaica in last year was given the mandate to control inflation, the management of interest rates is now considered a major policy tool of the BOJ. The policy of the government is about controlling inflation, and then BOJ is given the appropriate space to adjust interest rates such that it gets inflation within the target band. So if you want to characterize any policy, what the government has bound BOJ to achieve is an inflation rate and has left BOJ with the discretion to adjust financial conditions in the economy consistent with this path. So to the extent, I mean, nobody wants to increase interest rates, but to the extent that there is now this risk that inflation is going to rise over and above our policy, our target range over a sustained period, I think that is justifiable basis for the bank to consider tightening financial conditions. In the future, where financial condition, where inflation conditions are appropriate, the bank may very well find it appropriate to moderate financial conditions. Thank you.
Thank you, Mr. Stennett. We have a question from Al Edwards. The dollar is falling, which is raising good share. How much further do you see it falling by the end of the year? Can the BOG be Santa after a tough year?
Al, you ascribe to us far more power than we have. We're not causing the dollar to fall. It's just the forces in the marketplace. So I have no idea, whether it will fall more or increase. But what we do know is that we want whatever that movement is to be reasonable. So that is our policy, to look out for whenever the market looks erratic, whenever there's chronic shortage of foreign currency, and to step in and to fill that gap. But we don't have an outlook on it other than that. It has performed pretty well. It has reduced in the last month, and many people appreciate that. And I think that what it means is that going forward to the end of the year, expectations about it getting up to any astronomical number is probably moderated.
Thank you, Governor. We have a question from Keith Callister. Most of the inflation seems to be cost push from imported goods in China due to supply chain issues and shipping costs. Do you agree? And how will the rise in interest rates affect these increases?
Robert or Wayne, you want to address it beyond what I have said in this?
Let me start, Governor. The shock has happened, okay? And we can't do anything about the shock. What we're trying to do is head off the consequences of the shock. Because remember, the inflation process in any economy is not just about a cost push factor. It's not just about what the cause of it. It also involves what happens after you have this cost push shock. And what we are saying is that what we're seeing, there are a couple of things that have emerged from out of this shock. One, people's view about where inflation is going to go. And the governor explained ably the consequences of that on actual inflation. We're also seeing where underlying or core inflation is rising. So even though we have this shock, this external shock, and we can't do anything about that, what we're trying to head off is the second round consequences of those shocks. Because if we don't, we're going to end up into a situation where high inflation becomes entrenched in the economy. If that happens, and persons just have to cast their minds back to 15, 20 years ago, if we get back into that situation, growth itself will be affected. Now, I think one thing that is important to understand as a part of the context for all of this, the previous question spoke to the significant declines in interest rates over many years. Bank of Jamaica has been very accommodative. So we have, in other words, what we've been doing, we have been adding fuel to the economy. What we're saying now, we're seeing some risk that will cause that we don't want the fire to blaze up to burn down the house. So we are just trying to take out some of the fuel that we have put into the economy so as to ensure that the economy can stay on a stable keel and such that growth can continue.
Thank you, Wayne. Keith, if I could say, when you look at what has driven inflation in the last couple of months, one factor that has jumped out is that of rental rates. No, this doesn't have anything to do with the cost of goods coming into the island, but rental rates have increased quite significantly. And that's a good example of expectations. That the people who are landlords are saying, I am going to increase rental rates. Has nothing to do with the fact that corn prices went up or oil prices went up. It's just that let me take advantage of an environment of rising prices and benefit from it by taking a price increase on rental rates also. So that's an example of inflation expectation pulling inflation along. And it's those kinds of expectations that we need to combat.
Thank you, gentlemen. Mr. Collister has a follow-up. He states, you seem to have a greater emphasis on achieving exchange rate stability than in the past. Is this because you think merchants are raising prices as a hedge against exchange rate volatility? And you think that this has unnecessarily increased prices?
But I think any rational businessman, if he sees exchange rate moving, the next time he goes to buy, he expects it to be higher. He's going to price for that. That's just rational. What we are doing is saying, let us impact the economy as a whole and therefore the demand for foreign currency and make the market more stable. And that will feed through to more stable inflation, bring the rates down. So I don't blame a businessman for trying to recover the cost of foreign currency. But if he expects that dollar to be 160 in another month's time, that's a different issue than if he expects it to be 150. And we are trying to make sure that the market doesn't get exuberant and get to 160, but stay in a more rational corridor.
Thank you, Governor. Huntley Medley asks, is the most recent overperformance of the growth outturn likely to change the BOJ's growth projections as outlined by the MPC summary?
Robert?
Thank you, Governor. No, I don't think this is gonna materially change our outlook for the fiscal year. Just to repeat, we expect GDP to grow by 7 to 10%, which is a pretty wide band, and we have never given you a point forecast to indicate which part of that range GDP is likely to fall. There have been a couple of shocks recently that would cause GDP growth to tilt towards the lower end. Note is made of the disruptions at Jamaica, the passage of Hurricane Ida and Grace, and the 1 month intermittent work schedule that was occasioned by the tightened restrictions, all have the capacity to slightly retard the growth number that we would have been looking at. But but on the other hand, this particular shock, which adds about an additional 1.5 point to the GDP growth, is reflecting very noteworthy improvements in manufacturing, which we applaud, and this has been a little higher than what we were thinking. And distribution, wholesale and retail trade is also growing a little stronger. So on balance, I think we are still comfortably within the target rate, the forecast range of 7 to 10%. Thank you.
Thank you, Mr. Stinnett. I am not seeing any further questions. Does anyone else have any questions to ask? In the interim, I'd like to make you, ladies and gentlemen, aware that this conference will be posted to our YouTube channel and the audio will be sent to you. Okay, I'm still not seeing any more questions. So at this, okay, there's one from Huntley. The US Fed is far more cautious about a rate rise, even in the face of a doubling of inflation outturn over projections. Apart from the BOJ's statutory responsibility for inflation targeting and control, what makes the Jamaican situation more urgent, requiring a rise in the policy rate?
Wayne?
Okay, thanks, Governor. All right, the circumstances and the objectives of the US Fed are slightly different from ours. First of all, they have an explicit dual mandate of inflation and employment. So they condition their policy options to match both of those. They are not yet comfortable, even though the outlook is very positive. They are not yet comfortable in terms of where they're seeing employment relative to their target, which is the neutral rate of employment in the US. The other thing, which is and probably more critical, is that the US, in their approach to targeting inflation, is slightly different from ours. They want to hit a particular rate of inflation or an average rate of inflation over time. Now, they've had a problem for many years in that inflation and consequently interest rates was well below that target. So for them to get inflation averaging around their target, they need a period for which the actual inflation remains above the target for some time. That will allow them to get back to their average. I hope you're following. So this is why, even though actual inflation now is above the 2%, they're not responding to it because they want inflation to stay above that 2% for some time. So it's a slightly different picture that they are facing. But bear in mind, though, they have increasingly become more hawkish, if I should say. The indications that they will start the tapering earlier than normal. The Fed chairman just indicated that. And also, it is likely that they could start adjusting interest rates sometime next year.
And I would say the history of the US economy is one of moderate inflation. The history of our economy is one of pretty high inflation. And so we have to be a little bit more aggressive in dealing with it once it shows its head, because it's harder for us to control it if it slips out of a reasonable range. And that's why we want to act promptly.
Thank you for those explanations, gentlemen. We have a question again from Al Edwards. What positives do you see with the expected additional tourism receipts from this winter season?
Oh, we see a lot of positives, and I know Natalie will welcome it. We want to see tourism recover. Tourism is a big employment factor or sector for the economy, as well as providing foreign currency. And as the remittance flows taper off somewhat from the very high level it has been in the last year, we need to see those tourism receipts pick up back and pick up the slack. So we see everything to be happy about increased tourist arrivals.
Thank you, Governor. I am not seeing any more questions. Does anyone have any further queries? Okay, if there are no further questions, I'd like to thank you all for joining us this morning. And please remember that the conference will be available on our YouTube channels and the audio will be sent to you.
Thank you, everybody, for attending.
Thank you.